Well, joining me, Paul McCulley, Portfolio Manager at PIMCO, Don Luskin, Chief Investment Officer at Trend Macro, and our realist, he's our realist, I love him, Herb Greenberg, Senior Columnist at Market Watch and CNBC contributor. Don Luskin, can I just ask you, this is again unrelated to anything fundamental.
Sure.
Rudy Giuliani is throwing his hat into the ring. He is known to you. Do you regard him as a plus or a minus for the stock market?
I think he's a plus because I think he's a tax cutter, and his reputation in New York as a tax cutter and a guy who's tough on crime and big on taking personal responsibility, the eradication of the nanny state, those are all the things we need right now. I have to say, though, I will never forgive him for what he did when he was a U.S. attorney in Manhattan. All that stuff about insider trading and his attacks on Michael Milken, that was a terrible, terrible Elliot Spitzer-like thing to do. But I'm trying to put that behind me. I may actually vote for him.
Get over it. Get over it. Paul, would you consider, Paul, I appreciate that you're a Democrat, and by the way, we never have enough Democrats on this program, so welcome to you and your point of view. But, Paul, seriously, would you cross over, would you consider crossing over to make a vote for a guy like Rudy Giuliani?
Conceptually, it depends upon who my party puts up. To me, I am a card-carrying Democrat, and I define that foremost by the fact I believe in a progressive income tax system. So actually, if you had a Republican who would espouse a belief in a progressive income tax system, I could see crossing over. I'm not sure if Rudy would or not.
We already have a progressive income tax system.
It's less progressive than it used to be, Larry.
Well, yes, goodness, heavens, isn't that a good idea, pro-growth? But let's not go. I want to get to Ben Bernanke. All right.
Hey, Paul, you feel free to contribute more, whatever you think is right, okay?
Understood.
All right. All right, Don Luskin, weigh in on Mr. Bernanke, if you please.
Okay. First of all, we've got to give the guy a lot of credit for doing a good job at all here, because in his last job as the head of the economics department at Princeton, your alma mater, Larry, he was a miserable failure because he was the one who recruited Paul Krugman to the economics department at Princeton.
But listen, in fairness to Ben, he was one of the very few, at last count, I think 3 non-socialist members of the economics faculty at Princeton.
A great distinction, and all to his honor. My grade for his first year is going to be incomplete. We don't know how it's going to turn out. If you look at his self-evaluation, the statement that comes out every 6 weeks from the FOMC, they're all ready to give themselves an A. Inflation's going to come down. The economy will moderate. Soft landing. Aren't we geniuses? I promise. Next year in Jerusalem. But I want to see it happen. Gold is 15% higher than it was a year ago. The dollar is 5% lower than it was a year ago. Those are not good report cards from the market on Mr. Bernanke.
All right, those are some of the issues. You're exactly right. Now, I guess we're in the 3rd semester. Do you want Mr. Bernanke to lower the Fed funds target rate in the current semester?
Yeah, if you look out about 6 months from now, put it, July, August, I think that'll be about time for the Fed to start returning back from a restrictive level back towards neutral. I expect the economy to slow very demonstrably in the 2nd quarter. And I expect that inflation rate to remain on a downward track. And I think by the time we get out this summer, it'll make time for the Fed to have a little bit of a celebration party and back off on the short-term interest rates.
It's not going to, Paul. It's not going to happen. The next rate move is going to be higher because this economy is not slowing down. And the real test of Ben Bernanke, the thing that'll make his grade or make his failure, is going to be how he stands up to that test. Inflation is not going away. The test is going to be put on him to do something about it instead of just talk. And I suspect he will. And I'll look forward to giving him an A when he does.
Is this his monetary manhood?
It is. And, I think in the first couple of months on the job, he did a lot of talking. Loose lips sink ships. He had his lapse of judgment with your own Maria Bartiromo. I think he had some lapses of judgment with the Joint Economic Committee of Congress when he said some things he regretted. He's since learned to be more tight-lipped, more manly in the way he presents himself. But words or the lack of words aren't what it's about for a Fed chairman. Someday you have to make the hard decision. You've got to raise interest rates when it's unpopular. That's going to be what happens 6 months from now. He's going to have to make an unpopular decision, and I bet he's going to do it.
All right, I just want to note, the only money supply measure they have direct control of, which is the monetary base, high-powered money, that has actually come down quite a lot from, I don't know, 4.5% to 5% growth down to 2% growth. Herb Greenberg, I got to bring you in to referee this discussion.
I'm actually
Herb.
having a problem here because I'm finding myself agreeing with Don, which is just beyond me, especially after Don's comments on Giuliani and insider trading. I don't even want to go there. And Don, you know I love you, but anyway, I agree with him.
You like the fact that Rudy busted the Goldman Sachs crowd and the others. You like that.
I
You
was
see that as a
all
good
that stuff.
thing.
I was there at the time. Why not?
Well, Herb, how do you feel
a
about the
cop.
fact that every single one of them that went to trial was acquitted?
Hey, look, I think he was there. He was being a tough cop. We liked the tough cop.
Paul, what happens if Don Luskin scenario is correct and the Fed raises its Fed funds target rate? What would that do to stocks? What would that do to bonds? What would that do to the economy, in your judgment?
I think stocks would be taken out back and just summarily shot. Because I think the whole stock market rally since last summer, which has been a beautiful thing, has been on the notion of a soft landing lubricated by Fed easing. So therefore, if you actually get Fed tightening, I think the stock market's in a heap of trouble, which would probably feed over into the corporate bond market. But the Treasury market would probably be okay for the simple reason the Treasury market loves misery in other markets.
But Don Luskin, you basically agree with that, don't you? I mean, if and when the Fed raises their target rate in your scenario, you're going to sell across the board. You're going to have random selling in the stock market, aren't you?
But the reason is not because the economy couldn't stand interest rates 25, 50 basis points higher. That would be fine. The problem is, once the Fed gets going, it never knows how to stop. It's a slippery slope to overshoot. It's the overshoot that'll kill us. It's when we see the Fed funds rate at 6.5. And that's where it's going. That's where it's going.
6.5. It is presently 5.25.
We've been there before,
Go
man.
ahead, Paul.
They
Paul.
always miss. They always overshoot.
What's a 6.5%? What does that mean to bonds, to stocks, to bond spreads? I think, whoa, they're all going to go out behind the barn and get shot.
It means a bear market. It means a recession. We've seen this movie before. We haven't rewritten history. This is all going to happen again because they're going to make the same mistakes.
Go ahead, Herb.
What's interesting
Why
is
would
this
the
is from
Fed
Don.
do that?
Why
would the
Herb?
Fed do that?
No, all right. Why would they do it, Herb? Do you have an answer?
Well, no, I just want to give some credibility to Don for a second as the referee here and the realist here, because Don was talking about gold as something people should buy when nobody wanted to hear him. He was shot down by Kramer like nobody's business. And suddenly, he was a little premature, but he was so right. It was scary how right he was. And that's why you can't take what he's saying and totally discount it as something wacky.
Paul McCauley, what do you think?
I think
this
that
is a conundrum. Let me ask you this. I want to phrase this. This is, in some sense, a Bernanke-era conundrum. The bond market and the bond spreads are saying inflation expectations are minimal, and therefore the risk. All right, but the gold market. And if we stretch a little bit, the world commodity markets, which I know reflects China and India, but Don and others believe it's reflecting inflation. So we have gold commodities versus bonds. It has really been, in Mr. Bernanke's first year, the great conundrum. Who do you pick? Who is right in this debate?
Well, I think both can be right. I think that your break-even spreads can tell you that you have an utterly benign overall inflation picture, but you can look at your commodities in a global context and say that you're seeing a relative price change, that global growth is concentrated in commodity-consuming countries, and you're driving up the price of commodities relative to other goods and services. That's not an inflation phenomenon. That's a relative price adjustment.
Don Luskin, I'm going to give you the last word. I am sympathetic to what Paul just said. As you know, I've always believed lower marginal tax rates are counterinflationary, and the commodity boom is the world's spread of capitalism. Your last thought.
My last thought is watch out. Just as the credit spread is so tight, it's not prepared for any slowdown, any bankruptcies, the tip spread is not prepared for the big whiff of inflation it's about to get. So that means that when that whiff comes in and the tone changes, it's going to do a 180-degree whipsaw.
Herb Greenberg, quick thought. Who's right again? Who do you like? You like the Luskin scenario?
I go with the Luskin scenario.
All right. All right, I don't know. I love gold. I think the stock market looks great. And I don't know. I think this story is going to have a happier ending than some do. I give Mr. Bernanke a solid B-. I think he's done a good job. I'm still confused about his targets. He does say some strange things. On the whole, he's gotten the story right. And I cannot argue with the success of the stock market, which I think is the greatest economic barometer there is. Many thanks to Paul McCulley and Don Luskin and Herb Greenberg.